our previous discussions on bonds, we looked at the history and we looked at a little bit about durations. And of course, all bonds are not created equal. There's tips, there's strips, there's all kinds of different products out there, and each one of them has a specific purpose for your portfolio. Today we're going to talk about duration and how the duration of these specific bond products will impact your portfolio and the considerations you need to make when purchasing them. And conveniently for me, we have Bill Addiss back in studio. Thanks for joining me again.
Pleasure to be here again. Thank you, Will.
No problem. When we look at bonds, most people thinking it's a 10, 20, 30-year piece. But these durations are fluctuating greatly. Why do we have such a big discrepancy between these very short-term, 6-month ones to 30 and maybe even longer bonds?
The fundamental premise to understand is that when we talk about duration, we're really talking about volatility. That some bonds can be more and are more volatile than others.
Sure.
And there are times when you want volatility and times when you don't want volatility. If prices are going down, you might want bonds that hold their value more. If prices are going up, you might want volatility.
Right.
So if we talk about duration as a measurement of volatility, the most important thing to understand is that the single largest factor that affects whether a bond is going to be volatile to changes in interest rates is the maturity of the bond.
Time, the
length to maturity.
So for the layman out there, duration is just time.
It's time. And we use the term interchangeably. Sometimes people will talk about the duration of their portfolio, using it as a reference to the time to maturity. Mm-hmm. So we do tend to use the terms interchangeably, but I want to stress they're really not. Duration technically is a measurement of volatility.
Okay.
The more duration you have to a bond, the greater its volatility. But again, because the single largest factor that affects duration is maturity, that's why we tend to kind of lump it all together. Yep.
All right, so really, there's two impacts here with volatility. You have duration, which obviously is the length of time we're in the investment. Right. We have in previous lessons we talked about the different types of bonds. So you have volatility there as well. So you can be looking at a 16% junk bond versus a 1% treasury. Obviously, that's a measure of volatility. Now you add time, so you have two ways to value that out.
Right.
Let's talk about kind of the reason why someone might want to go with the shorter term one, versus the longer term.
Perfect. And to give you a real life illustration, many people are familiar and comfortable with the idea of money market funds. A money market fund is when you give the fund manager $1, you would always expect to get $1 back. And in fact, unfortunately, many people think that dollar is even guaranteed. Right. As we know, it's not. It technically could fluctuate. So when you give a portfolio manager money under a money market fund, you always expect to get the same dollar back. That means that portfolio manager cannot afford to have any volatility to that portfolio whatsoever, meaning they have to have zero duration.
And you're going back to our risk-free rate again?
Exactly. Here we are, the Treasury yield curve. Exactly. But because they cannot have any volatility, they have to have the shortest maturity possible. Mm-hmm. Well, unfortunately, in today's market, when you look at a normal yield curve, the short-term interest rates are the lowest. So what we're doing is we are forcing those portfolio managers to now have to invest in the lowest yielding sector of the market. They don't want to invest in the lowest yielding sector of the market. They have to assure you're going to get back that same dollar you gave them. Now, if you wanted volatility and you were willing to have that dollar change in value, then you would obviously go out and buy Treasury notes perhaps, or Treasury bonds that have longer maturities. They will experience more volatility with a change in interest rates. In the visualization we're giving you here, you'll see that if I have a fulcrum point and I look to the left, that's a change in interest rates. If the length of that bar is very short, not a lot of time, if I move the left side, it's not going to move the right side very much.
Right.
Conversely, if I have a longer maturity and the bar is longer, a very small change in yield on the left side will result in a more exaggerated price movement on the right side.
When we look at that illustration, it's important to see how powerful time is on this one.
Absolutely.
Now, one thing you mentioned here is I want our viewers maybe to get a little greater understanding of, because we haven't covered this topic yet, is the topic of yield curve. And from my understanding, the yield curve should be in a normal market that is going at standard pace and everything's fine. It's the example we just looked at. The short-term maturities going to pay you very, very little. Right. The longer term, because you're taking that risk of accepting volatility and time and duration, they're going to pay you more. That's normal.
That is a normal yield curve, exactly.
What happens when we get something where all of a sudden, let's say short term, I'm going to get 1% interest, and on the 30-year, I'm going to get 1% interest?
That's an aberration. And we could have a normal yield curve, exactly as you said, as a positive slope to it, meaning the longer you go out, the greater risk you're taking, the more you want to be compensated for that risk. So a normal yield curve has an upward slope to it. But the thing to remember is interest rates are dynamic. They're constantly changing.
Yep.
And the factors that affect a 30-year interest rate are going to be very different than the factors that affect a 1-month interest rate. They're not necessarily linked. So as a result, we can get very interesting swings to the yield curve, including in a most extreme example, as we've seen in our past, short-term interest rates being higher than longer-term interest rates.
Which is kind of a tough one for people to grasp. So that's like on the 1 year, you might be getting, let's say, 4%, and on the 30-year, they're giving you 3%. That's an inverted yield curve.
Absolutely. I first came into the industry in 1977, and in 1977, the one-day interest rate, the Fed funds rate we've talked about, was 21%. The 30-year bond was 14%. There was an inverted yield curve, and many people view this as an economic projection tool, that the yield curve is a forecasting tool. And I would point out an inverted yield curve is actually predicting a recession.
Right.
And we have had 7 inverted yield curves. It has been amazingly accurate, as you know. We've had 7 inverted yield curves in the history of the U.S. Each one has led to a recession. 100% accuracy to the yield curve as a forecasting tool.
Wow. So with regards to people picking the duration for their portfolio, is there kind of a rule of thumb? I mean, I know we've been kind of open here and saying, look, there's a lot of risk involved here, but is it as simple as saying somebody who is not wanting to take a lot of risk, really stick with the shorter term, or is there guidelines for that?
It really is so personal, I'm hard to give any gross generalizations. What I would say is you have to look at the duration and risk you're comfortable with. What we're saying is in a normal yield curve, your short, low volatility is unfortunately going to give you low yield.
Right.
If you're willing to accept a little bit more risk, and that's an individual decision, you might want to look at longer maturities because you'll be compensated for that risk. So it really is so personalized, I'm hard to make any generalizations.
No, it's okay. I just, we'll wonder if there's, in everything in life, is there the guidebook? Where's the recipe for it? And, as we've gone through these bond lessons here with Bill Addiss, you can see that there's a lot to think about. We have so many different variables to look at, but I think in this session here, we looked at duration, which is really a measure of volatility, and it's important to take a look at your own personal financial situation, say, what do I want? Do I want to take more risk? Is this risk capital, or is this something I'm looking to preserve and grow as an income stream going forward for retirement? We now have to figure which bonds to use, and probably the shorter term if you're looking for safety, longer term if you're looking for a little bit more risk.
One thing I might add before we conclude is the price changes that we're talking about is if you are choosing to sell your bonds prior to maturity.
Right, okay.
And that's an important consideration because remember, the feature of a bond is, assuming the issuer is still in business, the credit risk discussion, if you hold your bond to maturity, you're assured to get back that same $1,000 you put in. This price volatility we're talking about is really only an important consideration if you're choosing to sell the bond prior to maturity. If you're the kind of buy and hold traditional bond investor, this isn't going to be as important to you. So maybe you are willing to take on a little more duration risk.
Right. If you buy it and you're saying, okay, I'm happy with this rate. If I bought it in 10% or let's say 5% for a 30-year and I'm good with that, great. Keep it till expiration.
These price changes mean absolutely nothing to you because you're not going to be selling it.
You might be a little bit envious when you get up to 9-10% range out there. All right, so duration, a very important concept for you in your long-term investment portfolio. Why? Because a lot of those bonds are based off of time and duration. There's risk and volatility in there, so please, as you're selecting these products, be careful. Make sure you check out the duration as well as many other factors we've covered with Bill Addiss here in our bond lessons. If you want to know more, check out otacademy.com for more newsletters and videos on bonds and investment products.